Hello, and welcome to The Business Behind Small Business, the show that reminds you that just because you own a business doesn't mean you're a business owner. In each episode, we will discuss a common issue small businesses face and offer tips and advice from the perspectives of two business owners, one that built to sell and one that built to inherit. We are your hosts, Sevana Stone and Chloe Lee. There's a lot of business behind small business, so let's get to it. Today, we are going to dive into what commingling accounts are, what that means, and creating a healthy relationship with your company. Before we begin, we should note our disclaimer. We are not licensed financial experts, nor do we give financial advice. Anything we share with you here on our podcast, whether it be a personal experience or submission or advice, tips that have worked for us or that we believe would work for you, should not be viewed as either financial, business, or tax advice. We ask for you to do your research, have open and honest conversations with your company's own support providers, and make decisions based upon that. Throughout this podcast, we will share our knowledge and give suggestions and hope you will receive them as part of your overall research to better your own company. So, what are commingled accounts and how can that be a massive harm to your company?
Let's get to it. Just because you start the company doesn't mean it is quote unquote yours.
Yes, and I will also say that this is not isolated to startups, small businesses, freelancers, what have you. I have seen very large companies do this, and it can definitely harm you, and it inevitably harms you. So commingled accounts are when you transfer money between your business and personal accounts without documentation, or you use your business funds to pay for personal items. When you use your business credit card to pay for your vacation or to buy your groceries, oftentimes owners will use their business bank card to buy the family dinner. Sometimes you'll deposit personal checks into your business account to make up for some other time you use the bank card to pay for something personal, or withdraw money from the bank account and not write down what you use that money for. Or the worst case, you don't have a business account and you have just one account for both personal and business transactions. I like to explain to my clients this scenario to help them better visualize the difference between them and their company. And yes, listeners, you and your business really are not one and the same. Imagine your company is your child. Whether or not you have children, it doesn't matter.
Just work with us, people.
Just work with me for a moment. You feed your child food and you clothe it, you nurture it, and you do all of these things to raise a healthy human, right? Same goes for your business. You feed it with money. You nurture it by creating processes and procedures. You do the books, you market and promote, etc., etc. You do all this to raise a healthy business. Ask yourself, would you take the money your child earns as if it were your own? Would you make your child pay for your clothes, or when you take your child out for ice cream? You wouldn't. So why do you think it's okay for your business to just give you money and pay for your personal enjoyment? Maybe the analogy should just stop right there, but I hope that you get what I'm saying. Commingling is really, really bad for your business because it muddles what a business expense is and a personal expense. And plus, you never know how much your business is actually making or losing. If you can't tell the difference, how's your CPA supposed to know?
I'm sure this drives all accountants crazy.
Absolutely. I can't begin to tell you how crazy, but anyway.
So, there is a lot of repercussions to commingling your accounts, right? There is, of course, the tax repercussions. How you keep your books is pretty much how your taxes are reported. And so if your books are not clean in the sense that you are spending things from your business account for your personal enjoyment or personal use, or even from your credit card account, your business credit card accounts, the IRS does not take kindly for the fact that you're trying to run in business expenses to reduce your revenue for a lower tax liability when all those expenses are really your own. And if you do get audited and you cannot prove that to your fact, then you are screwed.
Yep.
So I like to say that with the IRS, if they come knocking on your door, you're basically guilty until you prove yourself innocent. It doesn't work the other way around, people.
Absolutely. If you could see me shaking my head, absolutely. The IRS will come and they will chomp on you, and they will take you for everything you own.
Biggest no-no too. If they see that, it's going to get vicious from there.
Yep.
That's the biggest thing. They do not like to see it when you do not treat your company like a company and on its own.
Yep.
Now, on the other end of that, just like, you yourself as a business owner, if you're commingling your accounts and you're, spending expenses for yourself versus for the company, it really kind of muddles your profit and loss at the end of the day, right? Mm-hmm. So if you listen to our prior episode about like the financial reports and what the importance of the profit and loss, you're really just kind of screwing with your own report in that sense. So when you look at your profit and loss, because you have all these expense items in there that really doesn't belong to you, it doesn't belong to the business, but it belongs to you, your bottom line is pretty much unclear as to how healthy your business is, how well it's doing it. And essentially, you've taken what would be a great measurement as to the progress of how your business is being built to being something completely worthless because you have all this stuff muddled into it. On the other side is that if you decide to hire somebody to do your books for you, let's say you're not doing it yourself and you have an accountant do it, and you're one of those people who really just wants to set it and forget it. So you're like, hey, I hired somebody to do this. I really, want as little involvement as possible in doing this. Where you're just kind of setting yourself up for failure because your accountant or your bookkeeper is not going to know what some of these items are and whether or not they're personal or they're for business. And guess what? They'll come asking you for answers, which means you're going to have to sit down and you're going to have to mark it out for them so that they can actually bookkeep for you correctly. So the easiest to do is don't do it. Your business needs to be your business. Your personal needs to be your personal. Now, if you get one-offs, everybody's done that where you pulled out the wrong credit card for like a lunch with you and your family or something like that. It's really a business credit card. The one-offs is fine. We're really talking about the ones where people will have a pattern of this. Now, I've seen a really common thing that is done where like the business owner basically doesn't take out any money from the business, right? So they feel like they're not taking a salary, they're not taking a payment. So instead, they decide they're just going to spend out of the business bank account for their personal stuff. And that's their way of taking things out. And again, depending on what kind of tax entity you are, like if you're an LLC, all right, so, as an LLC, as a sole proprietor, the IRS kind of sees you in a business as the same. So as long as you're accounting for it correctly, it doesn't really matter how you take money in and out of the business, right? They just assume it's all the same. It'll flow through to your personal return anyways. But if you're like in a corporation, like a C Corp or an S Corp, this is an absolute no-no. This just does not work. And you just cannot do this. There are very strict guidelines of how you can take money out of your business, and it's not through your personal piggy bank and treating it like your personal piggy bank. So super important to make sure that, you just have a really clear-cut line. And then, of course, especially if you get, when you get bigger or you're trying to sell your company down the road, this becomes incredibly important when your future investor or your future buyer wants to look at your financial statement and they see that you're doing something incredibly unprofessional, like commingling your accounts, which means they can't trust what numbers they're looking at, and you may end up turning away a very important investor or a buyer at the end of the day.
Absolutely. So when let's say you're there now, you've been commingling all this time, and now you need to stop commingling. How do you do that? Well, first thing you have to do is you have to separate your bank accounts. If you have not separated your personal and your business, that has to happen now. Keeping separate accounts also helps with tracking and recording your transactions. Your paper trail must be clean. I do want to use an example of a client I had a long, long time ago who commingled accounts, and the IRS did come after him. He did end up losing his company and he didn't end up going, but he did face time in jail for not having paid his taxes appropriately. He also did not keep his books clean. And what ended up happening is that it started to look as though his company was a hobby, because so much money was being taken out for his personal expenses that his company was showing a loss of revenue year after year after year. And it was so low. We cleared it up, we cleaned it up, and everything went back. He ended up having to sell the business, but it also was sold at,
probably had a loan that he had to pay back to the IRS for all the back dollars that he didn't pay for taxes. Yeah, that's like the worst thing to see too.
It is, and it wasn't a happy ending, but I guess it was happy that he didn't end up in jail. So that was the happiest part about it. But what I'm saying is that he borrowed so much against his business, or rather took so much money out of his business, that his business no longer looked like a business. It looked like a hobby. It made that little year after year. And so he did not get any of the other tax benefits of owning a business. It was a hobby, which made him, I think, it hit him emotionally as hard as it hit him financially. So very important that you keep your paper trail clean. Your business expenses on one end, your personal expenses on another end. If you have more than one business, each business should have their own bank account. This is also very, very important, because we're not just talking about commingling. We have been focused on the commingling of personal account with your business account, but there's also such thing as commingling business accounts. You don't want to commingle your business accounts either, because both business entities, literally two different businesses. If you have a business and you have like a job or something, like if you're in construction, you got different jobs, that's different. I'm talking about two different businesses, maybe two different LLCs, whatever it may be, of which I do have clients that are like that too, who have more than one business. But you should have separate bank accounts. They should both not be sharing the same bank account. They're both making money. They're both spending money. So then you should also have your own set of books for each one. They both should not be accounted for on one set of books. I've seen this before, and that is commingling also. Now we don't know how much your businesses are making. Yeah, how much is one business making? How much is the other one making? How much tax should one be paying as opposed to the other? And the IRS will come after you for that as well, because what they do is they assume how much money you owe. They don't just say, oh, let's look at your books. Oh, this is how much money. No, they're like, well, you're in this industry and this is how much money we think you ought to be making. So this is how much tax we think you ought to owe us. I have seen that time and time again. And I'm like, wow.
They do like their estimates, and it's always in their favor.
Oh, absolutely. Hundreds of thousands of dollars. It's insane. So that's another reason why you need to make sure that every business has its own lane, and personal business, or rather personal transactions, should be in its own lane as well. Your business is a separate entity. You must treat your business as a separate entity. Understand that you may need that income to survive, but so does your business. So another way you can stop from commingling your accounts is know what amount it is you need to live, and transfer out that amount plus enough for ancillary expenses, and do that with each pay period. And this speaks to your point, Chloe, about people who don't pay themselves.
Right.
This is creating a salary for yourself, and it's going to reflect that in your books. So pay yourself what you feel is necessary for your cost of living. Give yourself a little bit extra for any of those ancillary things, so that you don't feel as though you need to pull money from your business's account every other day, or whenever you feel like you need an emergency fund. Your company is not your emergency fund. Just pull enough that you think you need for your cost of living. If you need more than that, you can consider a loan from the company to you. Of course, you're going to have to pay it back, but you can take if you have a large portion available from your company that you need for yourself, certainly you can do that, but it is a loan, and you will need to record it as a loan. Or if your business needs money, you can loan it to the business if you have it, of course. If you have a chunk to give to your business, let's say to buy business vehicles, or maybe to buy a business building, or whatever it is that you need, your company already has its own credit, but you can also loan it to the business, but the business again must pay you back. It is a loan.
So, well, just to that point about recording it, it's more than just even recording it on your books, right? So if it's a loan, then have a loan document. have it all written up, signed off on, have it in writing, all the terms, treat it like it's an actual loan that you would have with a bank or anybody else. As long as you have it seemingly set up that you are treating the business as a separate entity to yourself, that'll go well in your direction if you, ever had to defend why you gave the business the loan or vice versa.
Right. Everything must be written down. I mean, you might not ever get audited. The IRS might not ever come after you, but it's good to know that you have it. And honestly, if you do end up selling your business or transferring your business to someone else, or maybe you hire someone who is outside of your company who's going to help you with, say, budgeting or helping grow your business, they're going to want to look at your financials. They're going to want to know where did this big chunk of money go, or where did this big chunk of money come from? You're going to want to have everything documented. It's just the right way to do business. And you want to do your business right. You want to be a successful business owner. You must. You wouldn't be listening to us otherwise.
Well, you also go into business and you have a company, not really just the fact that you can run around and say, hey, look, I have this company. But honestly, one of the reasons why you set up a company is because of the liability, right? You want the liability to kind of stop at the company instead of your personal liability being on the hook also. Now, it's not to say that somebody can't ever personally come after you for something, especially if somebody's just, lawyer happy and they just want to do that and find a way. But the idea of having a corporate entity is the fact that the business you do and the risk and the liability tends to be more heavily centered around that entity, so that if somebody were to come after you, they would come after the business first before they come after you personally. And if anything, like I'm sure people have heard the phrase piercing the corporate veil, right?
Yeah.
Right. So like that's the idea, is the fact that when you start commingling accounts, you're kind of piercing your own corporate veil in a sense, meaning that you're giving people like the opportunity that if somebody ever wanted to sue your company for something, because the fact you treat it like your personal piggy bank or, your personal playground and you're commingling funds, there has been multitude of lawsuits in which case the person suing you not only can go after business, can go after you, because the judgment is the fact that you're treating this business like your own and you and the business are the same. So that means that the person who's suing can sue both. And that just opens up the whole can of worms. And it is a little bit administratively like a headache to set things up correctly and really think about that too as you're doing different transactions. But honestly, like it is just not one of those things that you really want to push aside or become too lazy to do and just not pay attention, because it will get you later down the road. And it will be just a shame that you put all this effort into building your business only to be pulled down because you couldn't take an extra minute to think about what your transaction is.
Yep.
So with that, shall we talk about some famous examples?
Absolutely. In each episode, we like to connect a famous example to our discussion to help you relate our talking points on a more global or well-recognized scale. Sometimes we use exact examples of either famous persons or successful business owners of today or in history, and sometimes we use examples of people who inspire us and have inspired today's discussion. So, Chloe, who is your famous example?
Well, so the content of what we're sharing here comes from The Guardian. So my famous example for this is Adam Newman of WeWorks.
I love that guy.
Anybody who's heard the news for some period of time probably has heard what's been going on with WeWorks before. And so Adam Newman was just, man, that guy.
A colossal example.
I thought he outsmarted him like everybody, right? Just what an interesting character he is. So one of the things he did that Guardian talked about is basically so for those who don't know what WeWorks is, so WeWorks is a shared office space, right? So it came up on the market. It really took the market by storm because while there were shared office spaces before WeWorks, what they did was basically build up this very cool, hip atmosphere, very like tech forward, took that kind of Silicon Valley life, I feel like, and the office environment, and then made it available to everybody. And so any business owner can go in there, get a shared office space, and they can come in and out as they want, and they'll have access to like ping pong tables or pool tables, and like I think they're the ones that introduced like beer kegs, and then they'll have like Yeah, and they'll have like refrigerators of like juice and kombucha and just, all those kind of things. So it was just like all the rage. And well, so Adam Newman, brainchild behind this WeWorks founder, and the CEO, what he did was he bought properties, which then he leased back to WeWork, the entity, and then borrowed again his own stake in the company, enrich his own life.
It was all self-interest.
It was all in his own self-interest. And then this is the part that really got me, was the fact that he actually charged WeWorks, the company, his company, right? Because, I guess this is a way of treating your own company for yourself. He charged WeWorks $6 million to use his trademark on the word we.
Yeah. Yeah. Oh God.
I don't even know how you pull that off, because anybody who's ever done trademarks before, like it's really hard to get a trademark. Like, it's not really hard, but it's hard to get a trademark.
It's pretty hard. It's pretty difficult.
How in the world did he get a trademark on the word we?
Yeah. Look what money gets you.
Oh my gosh. So this guy right here, he also has a whole bunch of stuff he did. He had private jet trips. Let's see, what else did he have here? He had like private jet trips that, may or may not have included running stuff over international borders. He just did a whole bunch of stuff. And then I think he ended up having to pay that $6 million back, which is pretty interesting. But then he also
Yeah, but didn't he do that? I think a judge ordered him. It wasn't something that he did on his own account. Like, he was ordered to do it.
Not on his own account. This was revealed after the fact that I'm sure his board or whatnot probably had sued him or something. But then it was just crazy because even his projections, he was completely just falsifying them. Here's one thing where you say in 2017, WeWorks actually lost $883 million.
Yeah.
Despite having $886 million in revenue. So I guess, $3 million, give or take.
I honestly didn't think that there were going to be any real famous examples of commingling accounts, but he is, I can't think of anybody else.
It was blatant what he was doing. But even on a huge scale, right? You sometimes think that, this stuff is only for, the startups or business owners who don't know what they're doing. And, they're, it's for these small companies. But honestly, WeWork's maybe one of the more famous examples, but there are a lot of really large companies that, that aren't talked about in the news that oftentimes get in trouble for really not treating their business as a business and a separate entity from themselves. So.
Well, and it's important to know that Adam Newman ran WeWorks with the mindset of a small, very small business owner. It's not like he was, and now this is debatable, and this is an entirely another conversation, and there's documentaries and books and all kinds of stuff about this to try to better understand why he did this, but I kind of feel like his trajectory with WeWorks and how he approached it and the way he spent the money and commingled his accounts and commingled his interests was the same way I have seen very small business owners do it, where they have this belief that this business is making me money, and so it's my money.
So you're entitled to everything that goes in and out of the business, right? Exactly.
And so that kind of belief and way of thinking is what was his massive undoing, because his ego, this happens with very, very small businesses that make $150,000 as opposed to maybe $100 billion. It's the same kind of concept. I am entitled to this money because I created this company and it is my business and it is my money. There's a separation. There aren't a whole lot of famous examples for a good reason. It's going to sink your business. You cannot become successful by doing this, point period. I'm going to share with you a business owner who I think went from creating an incredible mess of his financials. Now, it wasn't as famous of a colossal example of commingling accounts, but he did have to file bankruptcy and he became incredibly successful again. So my example is George Foreman. He may now be known for his grill, but he was an impressive heavyweight boxing champion and had an Olympic gold medal as well. He is currently the oldest heavyweight champion in history, but during that time in the late 80s, he squandered his fortune with personal interests and ended up having to file for bankruptcy. Now, there was commingling involved, but it wasn't to the Adam Newman extent, and it did end up personally affecting him by a bankruptcy. He did turn his life and his fortune around by creating the George Foreman Grill, and is now speculated to have earned over $200 million from that now infamous grill.
Good for
him. Yeah, he did do well. Things did change. I mean, there were some other things too, but for the out of respect of time, I won't go too far into it. But I feel like George Foreman was one that kind of learned from his lesson and turned things around. With each episode, we like to share either books, tools, apps, platforms, or anything we think is a great next step and connector to our discussion. So if you like our subject matter and want to learn more, you'll have a great place to start.
Well, certainly, I think for the recommendation on my part is Hulu has a WeWork documentary that's available to kind of show you the very interesting trajectory and journey that Adam Newman took with WeWorks, and I think that would be quite an eye-opening
experience. It's an eye-opening
experience. There you go. That would be an eye-opening experience. And that's the thing is, like, I think we're saying that you can be large or you can be small. And I think you brought up a good point. It's really just a mindset. It doesn't really matter. And it's a matter of when you're going to get caught and when it's going to catch up to you, not if. And so, if you're lucky or unlucky, maybe it'll catch up to you when you're at the $800 million level. But at some point, it's going to catch up to you.
Oh, yeah, absolutely. For me, I can't say a book is going to help here. Although there are books available, I truly believe that if you haven't yet invested in a bookkeeper, you'd need to do so now. I also think you ought to sign up for QuickBooks, but remember, it's only a tool. You do still need a professional to manage it. And I say QuickBooks because I feel like it's
like we were not being paid to say QuickBooks.
No. We're not being paid for it. Well, I'd like to be, but I'm not. I recommend it only because I feel like it's the most user-friendly that I'm aware of. If there are others, certainly please let us know.
User-friendly and cost-effective, I guess.
Cost-effective, yeah. Yeah, absolutely. I feel like it's a good place for small businesses especially. But remember that it is still a tool. You do still need a professional to manage it. Some would argue, no, I can do it myself. But I would counterpoint that with the fact that I own a lot of tools. I actually have 2 massive toolboxes in my garage, and yet I still call professionals to fix things in my home, and I still take my car for maintenance. I don't attempt any of it. So
with all good reasons.
Yeah. That's just me. So anyway, please join us for our next episode. Who are you? Identifying your role within your company and separating yourself from your company. We're going to discuss what it is that you do, what your role and your responsibilities are, and how we can help you learn how to fire yourself from all the role, from
and
all
grow
of the
your
roles.
Company so you get to enjoy that 4-hour work week.
4-hour work week. Exactly.
Or be on the beach sipping a good drink, which what everybody thinks you are doing when you're a business owner.
Exactly.
We'll get you there.
Oh yes, definitely. I'm still waiting for my beach, my section for my yes. Bartender's taking too long. Want to ask a question? Leave a comment or become a sponsor for a future episode of The Business Behind Small Business? Click on the link in the show notes and fill out the form. Until next time, thanks. Bye.